Are you worried?
No, not yet. We are in the twilight zone of the business cycle, right? We're kind of beyond mid-cycle, which is really the Goldilocks period where growth is good, but inflation's not a problem. The Fed's on the sidelines. But we're not quite yet, but approaching late cycle, which is still not a terrible time in the market. It's not the down cycle. But late cycle is when you see inflation pressures and you see profit margins starting to contract a little bit. And typically that's when the Fed is raising rates, as it is doing now, of course. And the market tends to get more headwinds in terms of PE compression, tightening liquidity conditions, in this case also a firming dollar. So we are getting into that twilight zone here, but I don't see, and neither do my colleagues at Fidelity, really much of a risk of a recession anytime soon in the U.S. Earnings growth looks like it's peaking here, but it's peaking, at 23%, which is really quite a good number. So that doesn't mean earnings are about to contract, but it does look like they're peaking. And the PE ratio has already come down 3 points since January. It's at around 16.5 times forward earnings. So there's not a lot not to like about this market, but there are definitely cross currents here, and that's keeping the markets in check in this trading range that's now 6 months old.
Jurrien, one simple question here then. What exactly is worrying you about the markets? There's got to be something out there that you think that could derail the whole thing.
Well, so we obviously have issues in emerging markets. Turkey on its own, we don't think is a systemic issue. It's not contagious, at least not unless they impose capital controls, because then you could see forced liquidation across the EM space. China is slowing. Its currency is way down. China is caught in this monetary policy vice, if you will, because if you have a country and your currency is tied to another country, you're essentially importing that country's monetary policy, which China is doing, but it's in terms of U.S. Fed tightening, but it's doing so at a time when China's economy is slowing, and so China needs to ease, and it has been easing, but that's really knocked its currency way down. So China is always a systemic issue if it gets too bad. 2.5 years ago, we had another EM cycle, and China saw a lot of capital flight. It had to depreciate its currency. We're not seeing that now, and China's FX reserves are in check here. But that's certainly something that's on the radar. And obviously, trade, geopolitics are always issues. But ultimately, the risk is, and I'm not saying this is an imminent risk, but what could ultimately derail this bull market is what derails pretty much every bull market eventually, and that's inflation. If inflation really gets well past the Fed's 2% target, and it forces the Fed to go much further than the market is pricing in, and the market's pricing in 3 more hikes over the next 2 years, and that's it. That's the end of the cycle. If the Fed is forced to go far beyond that, then you get to the yield curve inversion kind of playbook, and then by 2020, 21, you could be looking at a recession. But at this point, there are no signs for that. But that would be the one thing that I would be looking at in terms of the typical economic cycle.